Welcome to the Association Management Series presented by Rayborn Group International. This session will be Avoiding Non-Profit Financial Pitfalls, presented by Jackie Williams, CPA. And now I will turn it over to Jackie.
I thought I might tell you a little bit about myself before we get started. I started my career in public accounting at KPMG Pete Marwick back in 1988 out in California, and while I was with them, I earned my CPA designation. I'm currently the Senior Director of Finance at the Rayborn Group, where I started back in 2001, so I've been with them for quite a while now. In addition to my finance role at Rayborn, I've also served as the executive director for 3 of Rayborn's clients. So I've had the opportunity to work really closely with several boards of directors to help them build and maintain good financial policies and controls. And I'll share some of that knowledge with you today. So here's what we want to accomplish. We're going to understand the volunteer leader's fiduciary role in an organization. We're going to learn how to develop a budget, identify key financial control policies, learn how to review and understand financial reports, and understand the IRS reporting requirements of a not-for-profit organization. Let's start by talking about what does it mean to have a fiduciary role? What are the responsibilities of a good financial steward for an organization? In your role as a volunteer leader, you're going to oversee the use of the organization's resources, whether that's cash, staff, capital assets. You're going to work to develop and maintain financial policies and controls, and you're also going to help ensure compliance with legal and regulatory reporting requirements. Now, while you need to be knowledgeable of all of these various areas associated with finance, you don't need to be involved in the day-to-day accounting activities, which are the responsibility of staff. So let's talk a little bit more about the difference between leadership roles and staff roles. Generally speaking, leadership governs and staff manages. Leaders are responsible for the direction and the future of the organization. They act and think strategically. They set goals and strategies for the future. So the leaders should be maintaining their focus on the mission, vision, values, and goals. They should be using good judgment when making those decisions. They should be avoiding conflicts of interest, so don't bring any personal agendas to the table. And you should be complying with the vision, mission, and bylaws. Staff, on the other hand, administers the day-to-day activities of the organization. They act in partnership with the leadership to help advance the goals and strategies, but their day-to-day responsibility is really the operations of the organizations and implementing the strategies that have been established by the board. And one of their specific responsibilities also includes managing the budget that was developed and approved by the leadership. All right, let's talk about how to develop a budget. At the start of your leadership term, you should be sure that you understand the budget process for your organization. So you're going to want to know who prepares the budget. Is it the treasurer? Is it staff? Is it done by a committee? What's the timeline to develop, review, and approve the budget? Does that timeline give you adequate discussion and debate opportunities? Is it approved prior to the beginning of the fiscal year? This budget that you approve is going to provide authority to spend both by volunteers who might be responsible for part of the budget and for staff to spend money in accordance with the budget. So it's really important that that budget be adopted and approved prior to the beginning of your fiscal year. Now, part of being a good financial steward of your organization also includes ensuring that the financial resources of the organization are spent in accordance with the group's mission. So you should be developing what we call a mission-based budget. When you start looking at what you want to include in the budget, you should look at your strategic plan and ask yourself if everything that's included in that plan has been funded in the budget. For instance, if you intend to increase membership by X% in the coming year, do you have a marketing budget set aside to do that? And is there enough money in that budget to accomplish what you want to? If you intend to go to some industry-related event in order to recruit new members, you're going to need to make sure you have appropriate travel funds. What's the fee to exhibit at that event? Do you have legislative initiatives coming up in the coming year? And what resources are going to be needed for that? Do you need to hire a lobbyist, for instance? Take a look at your conference. What's going on there? Have you invited a high-profile speaker like Michelle Obama? And what's her fee? So in the end, you should have everything in your strategic plan identified somewhere in your budget and have funds set aside to accomplish the goals. And once you've looked at the strategic plan, you also need to look at what else is in the budget, because certainly there are some recurring items that might be included there. Maybe you have a golf outing. Maybe there's a newsletter or other publication that you have. As much as possible, I suggest that you try to identify the profitability of each individual program or event. So if you have a conference, try to isolate the revenues and expenses for the conference, isolate revenues and expenses for the newsletter, so that you can see the profitability of those programs or lack thereof as you go through your decision-making process. There's a series of questions that will be helpful when you evaluate the worthiness of these various programs. So, first question, how does this program or product meet your mission? Does the program or product service align with your strategic plan? How much of a priority is it? If it's a low priority and there's other higher priorities, you might give preference to something else. Do you have the available resources to support that program? You might want to consider reallocating resources to other more profitable programs. How does this program add value to the members or your key constituents? And can or should we reallocate resources to increase or decrease funding for the program? Again, I'm going to come back to the golf outing as an example. Let's say this is something that you've been doing for years, you've always done it, it's a popular event, but in the end, it loses money every year. So you might want to ask yourself, if we didn't do the golf outing, where else could we be putting those resources? Maybe it would be better to end the golf outing, which we would be calling at that point maybe killing the sacred cow, in lieu of allocating those resources to your membership initiative, for instance. So now that you've asked these questions of all of the various programs that you have in the budget, you need to make a decision. And I would suggest one of three ways. One, move ahead. Yes, this program meets our mission, it's in direct alignment with our strategic priorities, and we have enough money to do it. The other option might be, well, you know, we like the idea, it's a good idea, but right now it's not really high on our priority list. So let's table it and maybe come back and take a look at it later. Or you can just simply say no. This does not fall in line with our strategic mission or priorities at all, and we should not be allocating any resources to it. Sometimes it can be hard to just say no, especially if you have a really high energy and enthusiastic champion for the program. So it's really important that as you go through this decision-making process, that you apply these questions consistently. The point of this process isn't to stifle the conversation or good ideas or to add another layer of decision-making to the process. And in fact, in the end, hopefully it streamlines the process of your decision-making. If you tell people in advance, these are the questions that we're going to ask, It will help them build a business case for their program or event and help you streamline your decision making on it. So you've looked at the strategic plan, you've looked at other key programs and events in the budget, but you still have to come up with, well, how much is it going to take to do all of this? And how are you going to do that? First, I suggest you look at historical trends. A lot of people say, you need to do a zero-based budget, which means you just start from scratch and, recalculate every number in the budget, but that's really not feasible. So, especially for items that are recurring, like office supplies, rent, utilities, things of that nature, go back and take a look at the historical trends for your organization for both revenues and expenses. And as on the expense side, use some sort of reasonable inflationary factor to increase it. Or if you have a contract in place like rent, make sure you're going back and taking a look because it probably has a built-in escalation clause in it. And that might be true for other types of expense contracts, or it could also be true for revenues. Maybe you have a publication contract and it says you're going to get a minimum of X amount each year. You're going to want to be sure that you have at least that minimum there, and then including the escalations from that contract. Also, you'll want to take a look at what you know about the future. Using your conference as an example, maybe last year you had the event in a very densely populated area like the northeastern United States, somewhere close to New York, and you know that that made it um, easy for people to drive to your event, and so your attendance was pretty high. Maybe next year, though, you're going to be in a less densely populated area, maybe someplace like Salt Lake City. You'll want to take that into consideration that maybe not as many people will be able to attend. So don't just make the assumption that because you were able to have 1,000 people attend your event in 2018, that that's also going to be true in 2019 based on what's going on and where your conference is located. Another area that you're going to want to consider are what are the economic conditions around the country and around the world that might be impacting your organization. For instance, if you were a not-for-profit in the real estate industry several years ago when there was a big downturn in the marketplace, you may have been asking yourself whether your members, if they were real estate agents, would be able to afford to attend. The housing market turned down, that means their income went down, so they're going to have to, pinch some pennies somewhere, and maybe that's going to mean they won't be able to attend your conference. So make sure you're looking at overall economic conditions that might impact your industry as well. So you're also going to want to look at, is the budget balanced? Now that you have everything in place, you've decided what stays and what goes, and you've done your best estimates on what it's going to cost and what revenue you're going to bring in. On the bottom line, is your budget at least balanced or shows some type of positive result? If it isn't, you're going to want to ask yourself why it's not. Do you have a one-time large outlay because you're putting a new project or program in place? And if that's the case, are you making an intentional decision to spend down any excess cash that you have on hand? Which if you budgeted it, hopefully you have the cash on hand to cover the new project. Or is your budget in a deficit position because of basic operational needs? You really don't have anything special going on. Well, there's only so many years that you can do that, run in a deficit before you run out of cash. So if you find yourself in that situation, you're going to need to go back and look at your programs. Again, this is where it's important to have made a determination as to what's profitable and what's not. If your annual conference is running in a deficit, you might say, gosh, it's been a while since we increased the registration rates. Maybe we need to bump those rates up a little bit. Or maybe you just can't afford Michelle Obama. We got to go with a different grade of speaker. The same would be true of your other programs as well. If you have a publication, maybe you need to increase your subscription rates. If you have the golf outing, are the fees appropriate? Do you need to bring in another sponsor? But in the end, your budget should be balanced, except under unusual circumstances like you're investing in a future program. So you have your budget in place. Now, what do you do to make sure that funds are spent in accordance with the budget, and how do you protect the incoming cash for your organization? You're going to want to put some policies and procedures in place. And one of the most important things you can do is look at segregation of duties. And what that means is that you don't have one person doing everything related to the transactions of the organization. Ideally, you're going to have one person who requests the funds. You're going to have a second person who authorizes the transaction. You're going to have a third person who processes the information, and you're going to have a fourth person who does the reconciliation. Those four segments are referred to in the Handbook of Professional Practices in Association Management as initiation, authorization, recording, and custody. Now, I know, especially in small organizations, it can be really hard to get a segregation of all four of these different segments. But I encourage you to insert as many different people into the process as possible. It's especially important to have someone independent from the processing steps to do the reconciliation. So if you don't feel like you can make that happen, consider outsourcing some of the components, such as the bank reconciliation or the financial statement preparation. It really is a small cost of pay to make sure that you have somebody independent taking a look at that and eliminating that possibility of one person taking control and misappropriating some funds. Another control you can have in place is making sure that somebody who is signing the checks is different from the person requesting the funds, and that's usually pretty easy to do. I also suggest that you have two signatories on all checks, and if possible, try to find a bank that's going to verify those signatures. Not all banks do that, but Rayborn Group works with a bank in Indianapolis who actually still does that. So shop around a little bit and see if you can find a bank who'll do that for you. Another control is to send a copy of the monthly bank statement to your treasurer. It's not the original copy, which still goes to the office, to the staff, so that there's no delay in the reconciliation process at the end of the month. So the treasurer gets a copy. And the point of sending that copy to the treasurer is so that that person can verify the checks that they signed and the checks that cleared the bank have the same payee and the same amount. So a key to that is that when you get the bank statement, it has to have copies of the checks that are clearing the bank. And somehow you have to keep track of the checks that you signed. But you can easily request a list of those checks from your staff. So it really is a low barrier to making this part of the control process work, but that's a really important one. So the long and the short of the segregation of duties message is the more people you have involved in the process, the less likely that they're all going to get together and commit fraud, because they are holding each other accountable. And that's what we call checks and balances. So do your best and consider outsourcing if necessary to make that happen. There are a couple other policies that I feel are pretty important to have in place. Number one is your travel expense policy. It's pretty common for not-for-profit organizations to reimburse volunteers and staff for travel, whether it's to board meetings or to conferences, other events. So you should have a travel policy in place that outlines what's covered and how much is covered. Maybe there's a limit on the airfare. You might want to say, well, there's definitely no first class travel, because what not-for-profit organization can afford to pay first class airfare? It should outline what documentation is required to receive the reimbursement. Is the original receipt expected? Is it okay to have a copy of the credit card statement instead? And who's eligible? What level of volunteerism? Maybe it's anybody who has incurred an expense on behalf of the organization, or maybe it's just limited to the board of directors. Your policy should also outline the timing for when that expense report is due. Is it 2 weeks? Is it a month? Is it 60 days? I certainly wouldn't let it go beyond 60 days. That's just getting too far out. I mean, everybody can find a few minutes within a 60-day time period to submit an expense report along with their receipts. If you have a corporate credit card that you allow volunteers and staff to use, those segregation of duties become really important, and it's very, very important that the transactions are promptly reviewed and reconciled. And it's extremely important that the person who is reconciling the transactions on that credit card and paying off the balance on that credit card isn't doing the reconciliation. If you can't separate those two responsibilities, then I highly recommend you close that account and just don't do it. Fall back on the travel expense uh, procedures instead. Commingling of funds. First of all, what is that? It's not very common. Commingling of funds would be when cash from your organization is put into the same bank or other account with another organization's funds. I have a hard time coming up with examples of when that would happen, but perhaps there's a related foundation that you have, and you've decided that it's just easier to put everybody's money all into one place, even though they're two separate legal entities. But just don't do it. It's too hard to figure out who owns what portion of that account. I think that would be a very, very rare instance that you would come upon a situation like that. But if you see something and somebody makes that suggestion, just say no. Just don't do it. You should also consider having a policy in place related to audits and reviews. That policy would cover what type of examination you're going to have. Are you going to have an audit or a review? It would also cover the frequency. Are you going to have an audit every year? Are you going to have an audit every other year? You're going to have an audit one year and a review the next year. Best practice would suggest that you have an outside CPA firm perform the audit or review of your organization's financial statements every year. So I'm going to, just to help you understand the difference between the two, I think it's important because there is a substantial difference in the cost of having those two different services performed. Of course, the audit provides the highest level of assurance about the accuracy of the financial statements, but it also is pretty expensive. I mean, it's not uncommon for that to, run $8,000 or $9,000. A review, depending on the size of your organization, somewhere between $2,000 and $5,000. Two would be on the really low end of that. But so an audit is going to look at detailed transactions. They're going to go, the CPA firm is going to verify balances in significant accounts with outside people, with third parties. So they might contact some of your customers. They're going to contact the bank and say, Are these balances in the bank account accurate? So they're going to get third-party verification and take a much harder look at the detailed transactions. So what the audit does is it provides reasonable assurance. And yes, I'm using some technical language on you now. But the audit provides reasonable assurance that the financial statements are free of misstatement, whether that's from errors, fraud, misappropriation of assets, or violations of laws. So that's a pretty high level of assurance. A review, on the other hand, is going to rely much more heavily on internal documentation. They're going to look at invoices, they'll look at your bank statements, they'll look at subsequent cash receipts, cash that's come in after the end of the year. But it's substantially less in scope than an audit. And again, here's that technical language for you. It is not designed to guarantee the accuracy of the financial statements, and it cannot be relied upon to disclose errors, fraud, or illegal acts. It's a much higher level look at what's going on in your organization. So I would suggest that as you prepare your budget, you take a look and ask yourself if you can afford to have an audit or a review done. I'm a CPA, so I'm probably a little bit biased, but I think it's really important to have somebody take a look at your financials. So if you can work it in your budget, I strongly recommend you do so. Investments. If your organization is lucky enough to have enough money that you are investing cash outside of just a money market savings account, for instance, you should have a policy in place that outlines the level of risk tolerance you have. What type of investment instruments can be purchased? Is it okay to buy stocks, or are you going to play on the really safe side and stay with government bonds, for instance? It should outline who's going to manage the investments and who can make changes. Does your group have a reserve policy? A reserve policy basically sets aside funds for future purposes or emergency uses. Even if you don't feel like you have sufficient funds to establish the reserve itself, I encourage you to go ahead and put a policy in place because it'll help you set a goal. Best practice would say 50% of your operating budget should be funded in a reserve account. So if you have $300,000 of expenses, you should have $150,000 in your reserve. The reserve policy would talk about how and when the funds can be used. When is it a rainy enough day? And how are they going to be repaid? And it's somewhat of a moving target. I mean, to the extent that your operating budget is shifting year to year, if one year you have 300,000, you need 150. Next year you went up to 400,000. Guess what? If you're suggesting 50%, then your reserve requirement went up. So you do need to monitor that. And even when you're budgeting, perhaps you even say, we don't have a reserve now, but as part of our budget, we want to come up with $50,000 to start funding the reserve. And my last point on the policies and procedures is to protect yourself as a volunteer leader. Ask your organization if it has directors and officers insurance. And if it doesn't, see if you can find the money in the budget to purchase a policy. What a directors and officers insurance policy does is protects you as a volunteer from personal liability. You don't want to lose your home, your automobile, or anything else because somebody comes and decides to sue the organization and actually wins for whatever strange reason that might be. So make sure you protect yourself, directors and officers insurance. Okay, so you've got your budget in place, You've got appropriate policies and procedures in place. The spending is happening, the money's coming in, and you need to know what's going on with the organization, what's its financial status. There are 2 reports that I suggest you request on a monthly basis. The statement of activities, which in a for-profit world would be called the income statement. The statement of financial position, which in the for-profit world would be called a balance sheet. Those are the 2 statements that you should be requesting on a monthly basis. You could say, I don't really want to look at it monthly, I prefer quarterly. You can do that, that's certainly your prerogative, but I feel pretty strongly about monthly. It's much easier to keep track of what's going on and to spot those variances as they occur rather than waiting until 3 months has gone by. I also feel like you should have a written narrative that accompanies your financial statements. And that narrative would come from staff, and it would highlight key variances from budget on your statement of activities. And it would also outline the composition of large balances on your statement of financial position. And we're going to take a look at a couple simple examples of both of those reports. But first, I want to talk to you a little bit about accrual accounting. And that sounds really complicated, but it's not. There's 2 basic types of accounting. One is the cash basis, which means you wait until the cash has exchanged hands to recognize any transaction that occurs. The accrual basis of accounting says we are going to recognize every transaction that has occurred regardless of whether the cash has exchanged hands or not. And in some cases, accrual accounting means cash has been exchanged in advance of a related event. And I'll go through some specific examples. So let's say you have a conference coming up in 2021. You've already booked the hotel, and as part of that contract, you had to pay the hotel a deposit. Well, you don't want to recognize that expense in the year that you signed the contract. It's 2019. That event doesn't happen for 2 more years. So you're going to save that expense. It's going to be called a prepaid asset. And you'll recognize it as an expense in the year it occurs in 2021. But right now, it's an asset because the hotel owes you the right to use those facilities. You might have products or services provided, but the cash hasn't been received. So maybe you had a conference in December of 2018, but your attendee didn't pay for that until January. If you had a December 31st year end, you're going to want to be sure that you book that revenue back. You have a receivable from that individual. They attended the conference, they received the benefit, you're entitled to the revenue. Excuse me. Or maybe you have money received, you have received money, but you haven't earned that money. That example would be, let's say you have, in 2018, you started selling exhibit space for your 2019 conference. Again, if you have a December 31st year end. The money that the exhibitors paid you in 2018 represents an obligation by you for the right to show their wares at your conference in 2019. And until you have fulfilled that obligation, you're not entitled to recognize that revenue, but the cash is still here. So you're going to have what's called a deferred revenue liability on your books to offset that cash. And then the other example would be, the last example would be, maybe you have received a product or service, but you haven't paid for it yet. So again, assuming a 12/31 year end, maybe you had a newsletter that was published and mailed out in December, but you didn't get the invoice from your vendor until January. Well, as of December 31st, that you had a liability to that vendor. They did what they said they were going to do, and just because the cash hasn't gone out the door doesn't mean you didn't incur the expense. So you would go ahead and book a liability, a payable, and the related expense. Okay, let's take a look at some examples, and I'll point out some of these as I go along. What you're seeing now is the statement of activities, also known as the income statement. My assumption here is that we are on a calendar year basis for our fiscal year, which you should ask that. If you don't know what your fiscal year is, you need to find out. So the statement of activities shows the date. It shows revenues and each line item for the revenues. It shows the expenses, each line item for the expenses, and it shows a change in net assets. In the for-profit environment, that would be profit or loss. But in the not-for-profit world, we call it change in net assets. So a good statement of activities should show you current month operations, actual compared to budget, and it should also show you year-to-date, actual to budget. So if we look at some examples on this page, and I'm not going to go through every single one of them, but what I have done is used a yellow and green highlighting just to showcase where you might want to take a closer look at some items, and items that if they're green are look like they're okay. So let's look at that dues revenue line item. In the current month, it shows that you were $200 below budget on dues. And year to date, it shows an even larger variance of $400. So you might be taking a look at that line item and saying, gee, is there a trend here? If April shows up and you haven't started catching up on that year-to-date variance, and it's, maybe if it's $600 in April negative variance, you're probably going to want to dive a little bit deeper into that and try to figure out what's going on. If we look at registration, this is an example of how looking at the current month versus the year-to-date can highlight different things. So in the current month, you are $250 better than budget on your registration. But year-to-date, you're spot on. So what happened there? Well, you're not going to be too worried because year-to-date, it caught up. But what that means is there was some sort of a timing issue. Maybe registration was supposed to open in February and it didn't open until March. That might be a reason that March has a higher number, but that year-to-date, you're spot on. Let's drop down to the food and beverage category and look at that one, because that's a little bit the opposite of what's happening with registration. In the current month, it looks like you're, pretty significantly over budget. You've got $600 over budget in the current month. But if you look at year to date, you're actually doing a little bit better than budget. So again, that's a timing issue. You may be expected to put down a deposit on the food and beverage in February, but it didn't happen until March. So what you see in this is the bottom line. Year to date, change in net assets is 75 negative, and year to date, you're minus 300. And your actual results show that you're $1,925 positive change in net assets for the year. And I want you to take note of that, $1,925 because it plays a role in your statement of financial position. So the statement of financial position, your balance sheet, typically not-for-profit organizations are pretty heavy on the cash as the assets. That's usually the primary asset. But depending on what's going on, you might have some accounts receivable. You should be paying attention to the accounts receivable number. If it's getting to be fairly significant and it's growing, you're going to want to understand what's going on there. Are those balances current? Are they collectible? Don't hesitate to ask those kinds of questions. At $250, I'm not too worried about it at this point. You have $5,000 in prepaid conference. That's the deposit that you paid to that hotel for 2021. And you have total assets of $20,250. So on the other side of the balance sheet is called a balance sheet because both sides of the statement have to balance. Total assets has to equal total liabilities and net assets, and in this case it does, $20,250. So that's broken out into accounts payable on your liability side. Again, you maybe still owe your newsletter vendor. You have deferred conference. That's the money that those exhibitors paid to you back in December, but your conference isn't until later on in the year. That's why you have that $5,500 sitting there. Then you come down into the net assets, and that's what would be called retained earnings in the for-profit environment. This current number, you see that? That's that $1,925 of your current positive change in net assets from the statement of activities. If you have restrictions showing up on your statement of financial position, you're going to want to understand what those are. On this statement, I show that somebody gave you $1,000 and said they only wanted that used to fund scholarships. Once those scholarships have been funded, that $1,000 restriction goes away. So make sure that you take a look at both of these statements, read the narrative, ask for a narrative if it's not provided, and ask any questions that you have. There's no such thing as a dumb question, and believe me, you would much rather ask a question that somebody else probably wants the answer to as well, rather than sitting across the desk from some regulatory agency asking you the question, why didn't you know? Why didn't you know that your accounts receivable was over a year old and wasn't collectible? So yes, even not-for-profits have to file with the IRS. There's a Form 990 that every not-for-profit organization has to complete. There's varying versions of that form based on total revenues. If you're a really small organization and you have revenues under $50,000, you get to file what's called a 990-N, as in Nancy. It's also called a postcard return. And it basically just provides contact information for the organization. What I'm going to talk about is what's called it's a long form, just like with your individual income tax returns. There's an easy, there's a long form. I'm going to focus on the long form. The long form is commonly referred to as an informational return. And that's because it asks tons and tons of questions. And I'm going to go over some of the questions that it asks, some of the key questions. But I want you to know it's due by the 15th day of the 5th month after your year end. So if you have a December 31st year end, it's due in May, the 5th month on the 15th. So what does the IRS want to know? They want to know if you have certain key policies in place. Do you have a conflict of interest policy? Is that policy monitored and enforced? Does that policy require an annual disclosure by the volunteers regarding any conflicts of interest? Do you have a whistleblower policy, something that protects potential informants, somebody who wants to come forward and disclose a misappropriation of assets? How are you going to protect those individuals? And do you have a records retention policy? Some of the key questions they ask: were the volunteers aware of any known significant diversions of assets? Are you documenting the minutes of your meetings, your board meetings, and your committee meetings? Was a copy of the Form 990 provided to the leadership prior to filing? Now, answering yes to these questions is not required. But by answering yes, you are showing the IRS a level of commitment and responsibility to good governance of your organization. If you're a pretty good sized organization and you're answering no to these questions, it could be a red flag. A couple other points about the 990. At a minimum, the treasurer or some other designated member of the board of directors should be reviewing that document prior to it being filed. The rest of the board members can receive it FYI. If somebody requests a copy of your 990, some outside individual, doesn't matter who, you are obligated to provide a copy of that form. So a lot of organizations put their 990 out on the website to make it available for easy reference. So typically, not-for-profit organizations do not pay taxes. But there are some instances in which you may be subject to actual money paid to the IRS. The IRS code has a section related to unrelated business income. And the IRS says unrelated business income are activities that are not substantially related to the accomplishment of the core mission of the organization. Advertisement is a very common type of unrelated business income and is subject to taxation. So if you have a publication and you're selling advertisements in it and it's over $1,000 in revenue to you, it's going to be considered for tax as taxable income. If you sell your membership list to outside organizations so that they can send mailers to your members, that's a potentially taxable item. And that $1,000 threshold applies to that as well. This is a very complicated topic, and I'll give you a couple examples. Advertisement revenue is taxable. It's considered unrelated business income, but sponsorship is not. We could go into the definition of sponsorship versus advertisement, but in the end, the company who is paying for those is receiving exposures to your members. So, it's kind of a fine line there. While membership list sales are taxable, if you prepare a membership directory and you sell it only to your members, that's not taxable. So those are just a couple of examples as to how complicated this can be. So if you have any questions about it, or you're above that $1,000 threshold, I strongly encourage you to get some outside expertise to help guide you through that. Get in contact with a CPA firm and have them walk through where you have areas of concern. There is a separate filing. It's called a Form 990-T. It has the same filing deadline.
Thank you for joining us for this session of the Association Management Series, Avoiding Non-Profit Financial Pitfalls. If you have any questions on this topic, please send those to info@rayborn.com. For more information on what services Rayborn Group International can provide to you, visit our website at www.rayborn.com.